You just bought a $50 pair of shoes. You tapped your card. The transaction was approved. You walked out. Simple. But in the 1.5 seconds that transaction took to process, your $50 purchase triggered a financial system that most consumers have never seen and almost nobody explains. There are 4 separate entities involved in every credit card transaction you make. You, the cardholder, the merchant selling you the shoes, the bank that issued your credit card, and the payment network, Visa, MasterCard, or American Express, sitting in the middle. Every single one of them has a financial stake in that transaction, and only one of them, you, is paying for all of it. Here is exactly how the system works. But before we get into the mechanics, the number behind this industry will put everything into context. Because the credit card industry is not just profitable, it is one of the most profitable financial systems ever constructed. And the way it generates that profit is hidden inside a transaction that takes less than 2 seconds. Here is what is actually happening every time you swipe. Credit card companies generate revenue from 3 distinct engines. Understanding all 3 is the foundation of understanding why this industry is so extraordinarily profitable. Every time a merchant accepts a credit card payment, they pay a processing fee to the card network and the issuing bank. This fee is called an interchange fee, sometimes called a swipe fee. Interchange fees are typically reported in the range of approximately 1.5% to 3.5% of the transaction value, depending on the card type, the merchant category, and the network. When a cardholder does not pay their full balance at the end of each billing cycle, the remaining balance accrues interest. Credit card interest rates, expressed as annual percentage rate, or APR, are generally among the highest interest rates charged on any consumer financial product. The third revenue engine covers the range of fees charged directly to cardholders. Annual fees on premium rewards cards can range from under $100 to over $500 per year. Late payment fees are charged when a minimum payment is missed. A late payment can also trigger a penalty APR that increases the interest rate on the outstanding balance. These 3 engines together, interchange, interest, and fees, combine to generate industry revenue estimated at more than $100 billion annually in the United States alone. Now here's the part that most credit card users have never stopped to think about. The rewards you earn, the cashback, the airline miles, the hotel points, feel like a benefit the bank is giving you. A bonus. A gift for being a good customer. They are not. And understanding exactly where rewards money comes from changes how you think about every purchase you make with a rewards card. Your rewards points, your cash back, and your airline miles are funded primarily by interchange fees. When you use a premium rewards card, the kind that earns 2%, 3%, or 5% back on purchases, the merchant accepting that card pays a higher interchange rate than they would for a basic no rewards card. The rewards you receive are essentially a portion of the fee the merchant paid to process your transaction, redirected back to you by the card issuer as a retention incentive. This creates an economic dynamic that almost nobody discusses. If you pay with a rewards card, the merchant absorbs a higher processing cost. If merchants spread that cost across all their prices, which many do to maintain consistent pricing, then customers who pay with cash or basic debit cards effectively subsidize the rewards of customers who pay with premium credit cards. The rewards are not coming from the bank's profits. They are coming from a fee structure embedded in the prices you and everyone else already pay. Premium rewards cards are not a gift from the bank. They are a redistribution mechanism, taking a portion of the interchange fee paid by merchants and returning it to high-spending cardholders as an incentive to keep using the card. The bank retains the net difference. Merchants build processing costs into product pricing. Cash and debit users pay merchant prices that include the processing cost without receiving any of the rewards. The rewards ecosystem is economically self-funding, and the cardholders who spend the most earn the most from a system that costs other consumers without their knowledge. Now here is where this becomes directly personal. Everything we have covered so far, Interchange fees, the rewards economy, and the cost transfer affects you whether you use a credit card or not. But the third part of this story only affects some consumers. And for those it does affect, it is the most financially damaging part of the entire credit card system. This is the interest trap, and the economics of how it is designed deserve your full attention. Credit cards are structured around a concept called revolving credit. Unlike an installment loan, where you borrow a fixed amount and repay it on a fixed schedule, a credit card allows you to carry a balance indefinitely, paying only a minimum amount each month. The minimum payment is one of the most carefully engineered numbers in consumer finance. It is set low enough that it feels manageable in the moment, but it is designed so that if you pay only the minimum, you will carry that balance for years, paying interest month after month on a principal that barely decreases. This is not accidental. The minimum payment structure is one of the primary mechanisms through which credit card issuers generate interest revenue. A cardholder who pays their full balance every month generates almost no interest revenue for the issuer. A cardholder who carries a balance generates recurring monthly revenue on the same debt. The credit card industry refers to these two types of customers by specific internal terms. Customers who pay their balance in full every month are sometimes called transactors. Customers who carry a revolving balance are sometimes called revolvers. The issuer's economic relationship with each group is completely different. Transactors generate interchange and fee revenue. Revolvers generate all of that plus interest revenue, which is typically the highest margin income stream in the credit card business. So here's the question this entire video has been building toward. If credit card companies have engineered three distinct revenue streams, interchange, interest, and fees, to extract maximum value from every transaction and every cardholder, is there a way to use the system in your favor instead of against you? Yes, there is. And it comes down to one fundamental strategic decision that determines which side of the credit card economy you are on. Here is the complete system. The credit card system was not designed for consumers. It was designed for issuers. But within that system, there is a specific set of behaviors that can turn the economics in your favor. The single most important financial decision in the credit card system is to pay your full balance every month without exception. A cardholder who pays their full balance every month pays zero interest. That means they extract value from the reward system without contributing to the issuer's most profitable revenue stream. Full pay cardholders use the credit card system as a tool. Revolving balance cardholders fund it. The entire reward strategy only works if you never carry a balance. If you cannot commit to paying your balance in full each month, a debit card is the more economically rational choice. Next, match your card to your highest spending category. Most premium rewards cards offer elevated rates in specific spending categories, typically 3% to 5% back on groceries, dining, travel, or fuel. Identify your single highest monthly spending category and hold a card that offers the highest rewards rate for that specific category. A household spending $600 per month on groceries and earning 3% back on a no annual fee grocery card captures more value than a household holding a $500 annual fee travel card they never use. You can also stack cashback on top of card rewards. Your credit card rewards and cashback apps operate on separate rails. They do not cancel each other out. Activating a cashback portal such as Rakuten or Capital One Shopping before purchasing through a retailer can earn portal cashback on top of your card rewards on the same transaction. On a 2% cashback card with a 4% portal activation, the effective return on that transaction may be approximately 6%, provided the portal tracks correctly. Finally, audit your annual fee cards every 12 months. Premium rewards cards with annual fees only make economic sense if the rewards and benefits you actually use exceed the annual fee. Set a calendar reminder 1 month before each annual fee renewal. Calculate the dollar value of the rewards you earned during the past year If the rewards earned are worth less than the annual fee, cancel the card or downgrade to a no-fee version of the same card. Many issuers may waive or reduce the annual fee if you call and request it, particularly if you have been a customer for multiple years. Credit card companies make more than $100 billion a year from 3 revenue engines built directly into the way you shop. Interchange fees embedded in every merchant's prices. Interest charges on balances that were designed to stay unresolved. And fees for the privilege of holding the card at all. The system was not built for your benefit, but it can be used for your benefit if you understand how it actually works. Next week on Price Decoded, we are returning to one of the most searched consumer questions of 2026. Which specific products are being hit hardest by tariffs right now? And what is the data-backed framework for deciding what to buy now versus what to wait on? The newsletter link is in the description. Get the new video in your inbox before it goes live. And if this changed how you look at every card in your wallet, subscribe, because there is a lot more to decode.